The Fed dropped its latest monetary policy update on May 7, and I'm going to tell you everything that you need to know about the Fed's policy update in just a few minutes. So, first off, what did the Fed do? They've decided to keep interest rates unchanged. So, the Fed funds rate is at 4.25 to 4.5% still. They have also decided to continue with the balance sheet shrinking that the Fed has been focusing on. So there's not been too much of change in this policy. That being said, there's still a lot going on behind the scenes, and that's what we're going to unpack. So the first thing that we want to take note of is the fact that the Fed has its hands full. So when we look at what kind of challenges the Fed has to deal with today compared to, say, in the last few years, there's a lot more going on now. So firstly, let's try to understand US government policies have been focusing on trade, immigration, fiscal policy, as well as regulation. So keeping these four pillars in mind, there's a lot that the Fed has to work on. So on one hand, you've had the president call for lower interest rates. The basic idea is that they want to reduce the cost of borrowing for the US. To do this, one of the policy tools that are available to the Fed is to lower interest rates. However, the Fed's mandate is to keep prices stable and ensure that there's maximum employment within the economy. The Fed's hands are actually tied and they may not be able to cut rates given their current mandate. So you've got these conflicting things that are going on, and you have a lot that the Fed has to keep up with, because on one hand, you're trying to shrink the balance sheet. At the same time, you're seeing the dollar weaken, and this has triggered capital outflows, and we'll get into that a little bit later in this video. But essentially, this is not an easy policy space for the Fed to be in, and it has a very challenging path ahead of it. This brings us to the second point that the Fed highlighted in its policy, which is that it's getting riskier. So if we look at inflation expectations as well as unemployment expectations, the risks in today's market are higher. This means that the Fed is expecting inflation to trend higher, broadly because of tariffs and other things that might come in, which might trigger logistical issues and those sort of things. The second thing is, on the unemployment side, also the Fed is expecting things not to look so great, even though the labor market seems pretty strong today. So given these two mandate risks are actually moving up, there is a lot that could happen in the US economy, which we don't really foresee. Of course, these forecasts are only point in time predictions, and predictions can be right or wrong. So there's no weight to any of these things, but what they're trying to signal is that the risks have gone up. So the probabilities of inflation remaining higher or unemployment shooting up have actually increased. The other thing that's also going on is on the dollar side. So if you've been tracking the DXY, which is the dollar index, you would have noticed that the dollar has actually depreciated in 2025. So one factor that we can look into is what's going on with the Taiwan dollar. This could be a sign of things to come for Asian economies, because what we're noticing is that the Taiwanese dollar appreciated against the US dollar by more than 10% this week. Now, why did this happen? It's a long and complicated story, but the essence of this is that the Taiwan Central Bank came out and said that they're not revaluing the Taiwanese currency so that, it's more friendly to the US, because the US has been saying that a lot of emerging economies have kept their currencies artificially low for a long time, which has been unfavorable towards the US. So the central bank has clarified that that's not something that they're doing as a response to the comments that have come in from the US Fed. The second thing that they've done is that they've told market participants not to panic and to continue to hold on to their assets, because panic selling can actually be more reactive and make the problem worse than it already is. The third thing that they have clarified is that they're not going to fight the market. This means that no matter what's happening between these two exchange rates, the central bank is not going to intervene and set an artificial rate in between. So this essentially could be something that isn't restricted only to Taiwan, because you've also seen the Korean won as well as the JPY appreciate against the dollar. The dollar has also been weaker, and this is in support of their argument that they want to export more to the world, because a weaker dollar could support that. But the second order and third order effects of having a weak dollar are yet to be seen. Lastly, the Fed remains confident. If we take out snippets from the chairman's address, there is a lot of positives going on for the US economy. So, firstly, they've said that even though there's heightened uncertainty, the Fed still thinks that the economy is in a solid position, and unemployment is not really a problem in today's economy, and they've made significant progress towards their inflation goal as well. So, this shows that the Fed feels that they're in a good place. And in terms of future actions, they said that the right thing to do would be to wait for more clarity. And although that their stance is restrictive, it's not too restrictive, and it's certainly less restrictive than it was a year ago. So, given all of this, it looks like the Fed is confident of managing the challenges ahead of them. What do you think will happen in the next policy that's taking place in June? Let us know in the comments below.